All right, episode 11 of The Wealth Architect. Thank you so much for being here. What if you could build housing that serves families, attracts institutional capital, and delivers double-digit returns all at once? Well, today's guest did just that. I'm joined by Scott Choppin, founder and CEO of Urban Pacific Group, the visionary behind urban townhouse models. Okay, this is really cool. A breakthrough in workforce housing that's delivering an average of 23.33% initial rate on return. I believe I said that right, on LP equity. From redeveloping iconic waterfronts to advising major family offices, Scott's 35 plus year in real estate prove that you can do good and do well. I love that. Let's dive into this model, reshaping California's housing future. And by the way, sharing these ideas could shape housing markets across the United States and the globe. Scott, welcome to the program.
Great to be here, Emilio. Appreciate the invite, man.
It's awesome to have you here. Thanks so much for being so accessible. When I was looking up different guests to have on, I mean, your profile and your vision and what you're doing really popped out at us because it fulfills such a really great need. So I'm excited to have you here, Scott.
Yeah,
Thanks.
Appreciate that. That came across in the narrative that we put out in the marketplace.
It did, man. It did. So Scott, you've coined the urban townhouse model. This is actually the first time I've heard of this. What makes it fundamentally different from traditional multifamily or build-to-rent housing?
So a couple different questions. So I'll answer in reference to traditional multifamily, apartment product as we think of it commonly, and then BTR is its own subsector, and we're even differentiated from that. So it'll be a two-part answer.
Okay.
So urban townhouse in a nutshell is a attached townhouse residential rental, product type or apartment type. And our differentiation is that we build all of our units that have 5 bedrooms and 4 bathrooms. Every unit has that design, including a bedroom bathroom on the ground floor that would house, say, an in-law or a grandparent. And these housing units are built predominantly, our mission focus is to house families. So think multi-generational, urban families, call it middle income, moderate income workforce housing. It has different names, but our intention is to fulfill a part of the marketplace that's really underserved, which is if you're a family of 4 or 6 or even 8, although that's rare, and you need a housing unit to rent, it's pretty rare to find anything that really would serve your family in the best way, right? Maybe you're having to put more people in less number of bedrooms. Maybe you rent 2 different units because your family's big enough to do that. But UTH or Urban Townhouse is a product that basically is intended to serve families, comfortably enable them to live a good life and to, share incomes and expenses across the family group to make the unit affordable, right? We're in California, affordable housing, we're the worst performing affordable housing marketplace, both in delivery of new supply, right? We're terrible at doing that, meaning as a state, as an economic and political body in the state of California. And because of that, we're also, have the least amount of inventory. And so people have to compete for apartments to rent, meaning the price goes up and the availability goes down. And so urban townhouse is, intended to fulfill that part of the marketplace that really nobody was paying attention to. I think we're the first to house families of this type, with this type of unit, certainly at scale. So that differentiation then applies to both, normal multifamily, which would typically be maybe studio 1 and 2 bedroom units. Like if you think about an urban infill apartment project in, say, downtown LA, it's going to have a lot of studios and 1 bedroom units because it's serving that population, young, smaller, not families, single individuals or couples, maybe roommates. And then as far as other BTR today would typically be a detached single family house. Like if you think from a national standpoint, like what would have been a subdivision house that normally would sell, it's now rented. And even those typically, 2 bedroom, maybe 3 bedroom, very rarely doing 4 bedroom, and no one in the for sale or BTR detached single family is doing 5 bedrooms. So we're differentiated also.
Scott, for our listeners, can you explain what BTR is?
BTR stands for build to rent or built to rent, depending on who you talk to. And what that means is basically it's a apartment rental housing type that would traditionally be sold to an owner.
Got it.
And instead of building to sell it, you build it to rent it.
So there's a rise in ADUs, right? The auxiliary dwelling units, that we see, and states are getting a lot more lenient on zoning requirements and on permits and this and that to make sure that people can push these through because we have a shortage of housing. Are you building these, or are these already existing units, and are you just
Meaning our projects
yeah,
generally,
your
like
projects?
each, yeah, all of our stuff is new housing,
It's new.
like across the board. We don't invest in apartments, existing units. We're a pure play development firm that basically takes empty land, or sometimes we'll tear a building down, but we always build all new units. I will add, just to reflect your comment a minute ago, we actually, wherever we can, we'll actually insert ADU units into our new construction UTH projects. But under the state law, we're generally, we can do maybe a couple ADU units, per project, which is the state law now. But anytime we can, and it's appropriate, we'll find a corner of the lot that doesn't have a building on it in our new construction and add those ADUs. We don't at this point convert garages of new units into ADUs, just because the parking, I didn't mention, but all these UTH units are 5-bedroom, 4-bathroom. They all have a 2-car garage. So it's very much like a living in a house. It just happens to be an attached unit that you can rent. So therefore, we don't ADU convert the garages because the parking ends up being pretty important to these families who want to use it for parking.
So how many units are you building at once in a neighborhood?
So our project sizes right now, so we're putting together a deal with Morgan Stanley to be our equity partner on a 4-deal portfolio that we're working on now.
Mm-hmm.
Those projects range from 44 units to 74. So it's, 44 units, 48 units, 73, and 74 units. So that right now is our sort of sweet spot for size of projects. We on occasion will do smaller stuff. And if we can, and it makes sense economically, then we'll do bigger stuff. We don't have anything larger at this point than the 74 unit project is the biggest one we have on deck.
Okay. Got it. And are these rents when they're going to market, or are they subsidized, or are they market rents?
So basically, this is one of the unique things about our offer is that this is not a subsidized affordable housing, what I call true affordable,
Mm-hmm.
which would be government subsidized, rent restricted under some program like, low income housing tax credits, LIHTC for short. What we're able to do is basically use private capital paired with that workforce housing model and basically enable a unit type to be rentable by these families. And one of the real secrets to the unit type is that basically this is a multi-generational family, let's say 2 or 3 related generations, grandparent, parents, kids, maybe some adult kids living, maybe in-laws, that kind of thing. And what that living lifestyle allows these folks to share their incomes to pay for the housing amongst more earners. So we call it multi-generational and also multi-earner.
Yeah.
These are the households that rent in ours. And, roommates are multi-earner too, right? And we do rent to roommates. The goal and the nature of the housing allows people to share these economics. In other words, like, anybody who ever lived in a roommate situation, whether you're in college or anywhere, you practice economic sharing. You didn't call it that, but you pitched in to share utilities and you pitched in to share the rent, and maybe you guys bought food together. These families already do that. We're just giving them a single unit type with 5 bedrooms for which to do that.
Mm-hmm.
Often we'll be pulling, maybe related families out of 2 apartment units where they're practicing economic sharing and sharing income expenses, and we are able to draw them into one brand new housing unit with 5 bedrooms. So that is what keeps the rent affordable in the context of their incomes. That's the real key. It's not that you reduce rents or not reduce rents. It's does the family earn enough to enable the rent payment to be done affordably or not?
Mm-hmm.
Right. And then you sort of work the economics backwards from there.
So how many of these total units do you have together? How many doors in total?
Oh, well, let's see. The Morgan Stanley portfolio is like 240 units. And then we have a couple opportunity zone projects that we're working on. That's a tax incentivized equity program. That's another 100 units. So right now we're, like I think it was 370 units, if I'm doing the math correctly, 377 that we're working on presently. And then we're looking to add more. And then just to add a little bit, we've been doing this for like 8 years. And so we have 7 completed projects that we've built and rent and sold, hence the the internal rate of return number that you referenced earlier in your intro. So we've been doing this program for a long time. We've proven the 5-bedroom model. That's one of the things that we started out early was, do some small, what I call demonstration or experimental projects. Let's make sure this stuff actually works, makes money. We can build it for our projected cost. And then from there, from that experimental phase, over the last probably 4 years, we've been now into what I call a growth phase, which is to go do now institutional scale projects. Hence the 4-project portfolio that I mentioned earlier. So I think we'll grow into that 50 to 100 unit range, nicely over the next 2 to 3 years. And then beyond that, we may do bigger projects, but the market will tell us, what kind of absorption can be handled by bigger projects.
So for our listeners' sake, okay, and we have a lot of people that own, rental properties. We have some of our listeners might own hundreds or even thousands of rental properties. What is the typical rate of return that, landlords are seeing on their doors?
When you say landlords, you're talking about like a typical landlord who bought an existing apartment project?
Multifamily or apartments, and I know it's a wide, you know what I mean? I know it's a wide angle look at it, but just with the research that you've done, are you seeing like a 8%, a 10%, or?
Yeah, let me answer the question a little bit differently than what you're asking it, but I know where you're going with this. So right now in the institutional capital markets, investors really want to see a 7% yield on cost. And so if you took your NOI that you're generating divided by your cost of, it's an existing asset, the acquisition plus, value add upgrades, that would be your all-in costs. You divide that, your NOI by that number. For us in new construction, we divide the NOI by the total cost of the project, which
operating
is land, hard costs, all your soft costs. And so we're very fortunate that our projects basically are producing high 6, low 7 yield on cost, which is right in that area we want to be for institutional capital. And then as far as other investors, it's just going to depend. If somebody's owned an asset for a long time, they should have a very high yield on cost, right? Their NOI should grow over time. Their basis that they bought for, the project for 15 years ago is not going up, right? They bought and that their basis is fixed. And so your yield on cost should grow over time if you're having decent rent growth and not overly large operating expense increases. Newer value add that was done in, say, like the 2020, 21, 22 era, I think you would find they're going to have some lower yield on costs because they bought at the peak of the market. This is one of the sort of things happening. And, a lot of your owners and investors in your audience would know this, that those projects are under pressure because they paid the peak price to purchase the property plus the value add at that time. And those projects are starting to wash through the system in essence, that they're, finally needing to either do capital calls or they need to sell the asset. And, some of those projects are underwater. Which means, underwater could mean different things, but, often what it means is that you're selling it for less than it costs you to acquire it, right? And that would be, in a down market investment scenario, that'd be below market costs or below replacement costs rather. So it's going to just depend on the product category, new construction value add. It's going to depend on the marketplace, right? Like, Texas is going to be under more pressure for yields because basically they've built so much more new housing. The supply is very large, particularly Austin, versus like a place like California, where we are very supply constrained and continue to be so. And I'm not saying projects in California won't have downward pressure, but the probability of that downward pressure being like large enough to affect the project even fatally is going to be a lot less, right? Because there's just a lot less supply. Now, California has a bad rap. Right, a lot of people stay out of California. They go, it's politically, it's difficult. Zoning is hard. Landlord regulations are difficult, and that's all true. But my counter argument for people is, look, if you know how to operate in the state, like we've operated for 35 plus years, you know how to pick good projects and do it in a way that you bypass some or most of the regulatory friction. And then what happens, because the supply constraint continues and will continue for the foreseeable future, when your asset is completed and rented up, it's very valuable.
Oh, sure.
right? Because it's supply constrained, economics, supply constraints should drive prices.
So, I mean, you've learned a lot. You've gone to the school of hard knocks. You've
Mhm.
learned, by probably failing forward as most of us do. And you were talking about how you kind of tested the different models, the different size apartments, and the different bedroom count. But how did you first spot this opportunity in multi-generational workforce housing,
Yeah.
and why do you think more developers aren't chasing this?
So the way I recognize it, I mean, I've always sort of been a person who's always looking for, some cutting edge innovation that we can adopt or create ourselves so we can
Sure.
stay ahead of the competition. So just philosophically, I'm tuned to be looking for that. Like I've got people that I learn with for business strategy, and they think that way. So it prompted me to start thinking that way. And then the way I identified UTH is just a little bit of background. So my early career in development, I worked for a subsidiary of what's now called KB Home. That subsidiary was called Kaufman and Broad Multi Housing Group. Kaufman and Broad being the old name of KB Home.
Hmm.
And I worked for that company doing affordable housing ground up development. So low income housing tax credit projects, all new construction, all ground up. And I did that for several years with them. And what that did is that taught me sort of to understand that part of the marketplace that's sort of the affordable, maybe workforce housing marketplace. In other words, I wasn't doing luxury housing, I was doing affordable housing, right? And all the sort of demographics that come with that, sort of the market characteristics that come with that. So in 2016, we had completed a series of projects. This is post GFC. So between like 2011 and 2016, we delivered a series of projects. Those all made money. We did well. We sold them all. And I started to look around for the next set of projects, as I do. And at that point in time, there's a little wrinkle in the marketplace that sort of demonstrated that maybe doing more of what was commonly done in California, which is podium projects, think like 4 or 5 stories of stick built apartments over a parking structure below grade. That would be a podium. That product type with the unit mix that comes along with it, which was studios, 1s and 2s, maybe that wouldn't be the best space to compete in. And the reason to not compete in that is all the big players were starting to come back to California. So think like Trammell Crow, Holland Partners, Graystar, all the big institutional development shops were all flooding back into California in 2016, 2017. And the wrinkle in the marketplace was bankers and investors got a little worried that, hey, we're going to have a bust again because there's so much product coming online. That was sort of post GFC, right? Post traumatic, PTSD kind of syndrome. Everybody was nervous and scared, right? Like they didn't want to go through 2008 again. And so they pulled back, but that ended up, if you had invested in 2016 and held through, today, you'd been brilliant, right? Like you would have been, smartest guy around. So what that did is that basically just prompted us like, oh, maybe we don't compete with all those big institutions, and not that we couldn't. My logic was this, Emilio, is I didn't want to go into whatever the next recession is or was at that time and compete against those big players because they would be able to drop rents and wipe us out if we were in a competing project next door. And I said, what can we do to not be that, not have to compete head to head with Trammell Crow? And so we came up with, we started to riff on various ideas. And one of the things I remember from my days at KBMH was that we used to build a lot of 4-bedroom apartment units in the affordable housing projects. And those were always vastly oversubscribed by families that wanted the 4-bedroom affordable housing unit. And there was never enough. And there was always like, 3, 4, 5, 6x of applications to available units. And so I started to riff on this idea of like, okay, maybe think about families that need rental housing.
Yeah.
I know that the constraint is there. There's not enough of those units. There's families that, make good money in these multi-earner households. And so I basically arrived at this idea of like, let's focus on family housing, but let's do it in a private market situation, meaning private capital, not government subsidy. So we can get out of that, that very competitive affordable housing space. And so that idea of, workforce housing paired with private capital ultimately became UTH. That was sort of the basis for it.
What a great vision, and fulfills such a great need. And I'm seeing, like we were talking about before, the multi-generational households are only increasing because it's so expensive. Housing has never been more expensive. And people also are having a hard time paying for daycare. So if you can
Yeah,
have grandma and grandpa live in the house, or
yeah,
maybe grandma is widowed and she stays and helps take care of the children, it's a beautiful thing.
yeah.
I love what you're doing, and it's all
I
about
appreciate
the family
it.
unit is so important. And
Yeah, I really nobody's focused on families. I mean, maybe the affordable housing folks would be because that's sort of like the nature of their offer to some degree. But from a private market standpoint, we're one of the few that's really focused in that space.
Yeah, thank you for doing that. That's huge. I've got a
Appreciate it.
question for you, Scott. Who are the five most important professionals to have in your network?
The first I mentioned a little bit ago. I think having a network of people around you who are in a constant state of learning
Mm-hmm.
and adopting new technologies or new innovations, and also having that group of people be able to work with them and think strategically together, right?
Mm-hmm.
So I belong to this group of people who are oriented that way. I mean, people might think of it, like there's some various groups like YPO and Vistage would be some examples that might be familiar to people
Great groups, yeah.
widely, and those groups are really good. But the group I work with is really intended to apply high level strategic thinking and the knowledge needed to do that effectively to your business, whatever that is.
Mm-hmm.
Right? It's agnostic to the business type. Like in this network of people, I have people that are really rarely real estate people. I've got a couple of people that are in the development space. A lot of you've got law firms. You got all sort of mix of different businesses, but we come together and think based on fundamental business principles, right? And so I found that working with human beings, right? Like if you think about business, it's human business fundamentally, right?
That's
You're
right.
always transacting with other humans to raise capital, to find new projects, to rent a unit, right? Those are all human interfacing activities. Okay, so that's number one. Number two is, I think for me, I'll answer from my standpoint, capital is the heart and soul of these projects. So we're in a constant process of raising capital. So good capital advisors.
Mm-hmm.
If you're a real estate investor, you would meet these capital advisors who then introduce you to operators like us and vice versa. And then for us in our business, we are heavily reliant on design. Folks like architects and civil engineers, they help us execute. And then I would say probably, and this is maybe not a great ordering, but I also think, like networks of help related to, executing well, right? As a company or as a team, right? Like, are you doing your business effectively, efficiently, strategically? Are you able to have people that work on your team that enable higher level executives to operate autonomously, to work on visioning, work on the strategy that like a CEO or a president would work on, so that you might call those employees, you might call those colleagues, but people who help you execute well, maybe the fundamental way to think of it. So I think that's four. And I'll probably stop there because that's probably a pretty good list. You
Yeah.
said five.
No,
I'll
no,
stop
no.
there.
You've got a great list, and you've answered that. What I love about the human experience is that you can ask a question and it could be interpreted, and you answered it correctly, right? But you interpret it differently than I asked, right? So I was actually thinking like, is it your CPA? Is it your barber? Is
Yeah,
it your
yeah,
realtor? Is it but I
yeah.
love what you put in there because you put even more detail in there. And capital advisors is one that really struck me. Can you explain? And I've got some other questions for you, but can you
Sure.
explain real quick to our listeners, like who a capital advisor is? That's a professional, or is that
Yeah, I mean, people sometimes call them brokers. Nobody calls them capital brokers, or at least that's not a common term. But these are an intermediary that like has a network of people that they bring together for capital to meet deals and deals to meet capital, right? And so this would be, could be well known names like JLL, they do that, or they have a group of people that do that. CBRE, Newmark, all the big companies have the those capital advisors. And so what they do is they basically they build networks on both sides. So they build networks of people like me that are developers that need capital, or sponsors if you're doing value add that need capital to buy their existing assets. And then they have a network on the other side of capital providers, right? Maybe call it allocators, or be fund managers, or be institutional capital sources. And that person's job is to basically pair those people up effectively, right? So developer meet, investor, investor meet developer, the capital advisor is the intermediary, between those two.
I love that. It's fantastic. Coming from, I originated in the residential real estate world. And as I'm growing my business and growing my portfolios, I'm getting more involved in commercial and in development. So literally the whole reasoning behind the Wealth Architect is so that I could interview amazing people like you and learn all of these great things, because how else, like where else does somebody have to plug in and tune in where they can learn from a different type of developer? Last week,
Yeah.
we had a gentleman that built strip malls,
Okay.
and now you've got this urban housing, which is absolutely brilliant. And you've got this urban townhouse model, which is just offering such a great return on investment for investors. I've got a couple of questions that I want to get through real quick. We've got about 5 minutes left here,
Sure.
but for someone listening who wants to break into development, Scott, okay, what's the lowest risk path to get started?
Great question. So I wrote an article. If people want to reach out, and we'll give our contact info at the end. I actually wrote an article about this, like a sort of ebook style, long form article.
Nice.
And I basically recommended different ways of people to break into the development business. So really, to answer your question, there's really two ways. I recommend that people, if they want to break into the space, offer themselves as free interns for real estate developers.
Love that.
Right. And so your goal with that is to basically get exposure to anything at all you can get exposure to in the development space. I don't care what it is. Is it construction? Is it acquisition? Is it underwriting? Whatever. You just need to get exposed. Okay, that's the first one. And then the other one is, if somebody's more sophisticated and they have capital, so like there's a recommendation I make for like a value add investor or sponsor, and they're like, oh, I can't find enough value add deals that work well. I'm not doing, I don't have the deal flow that I want, or the transactions that I want. I want to, I'm thinking about breaking in the development space. I will recommend those people that they go find a deal and JV it with another developer. It's the same sort of exposure to a sophisticated developer. In this case, you find a deal, maybe they pay you a fee, maybe you become a JV partner with them. But again, the goal is to basically get access to them doing the process, right? That's the key. That's the fundamental, is you need access to somebody doing the process so you can observe and adopt and understand what they're doing. I talk to people all the time, Amelia, who want to go do their first deal and they've never done development at all. And, occasionally I might recommend, if somebody's got the right set of skills, to go do that, like do it on their own. But I think you're going to get much better investment returns on your time and money and energy to, basically walk us along somebody else who's already doing it well.
Oh yeah.
Right.
It's a complicated
watch
business.
What they do, and like you said earlier, it's like, we've all been through it and learned a lot of, lessons.
Yeah.
I tell people, look, avoid if you can, learning the hard lessons. I mean, skip that. Like, some people are like, yeah, I want to learn the hard way. I go, don't. Learn the easy way, man. Like, go, like, be a free, I don't want to work for free. It's like, look, do that for 2 years. And I pretty much promise you will get a huge education that's far more valuable than whatever time you gave up and the cost of that time. If you're thinking about it from a wage standpoint, you want to get exposure to that, already been through their process and learn the hard lessons and do this, don't do that. Here's how we do it.
That's probably the best advice that anyone listening is going to get, because developing has so many different there's so many different moving parts to it. And in addition to that, you need a network. So
Yeah.
by going in and working for quote unquote free with a developer who is seasoned, who knows it, you're also tapping into their resources.
Yeah.
You're
That's
learning
right.
the process. You're going to get a return on investment that is immeasurable and it's going
Mhm.
to compound throughout your career. You're going to
Yeah.
be able to speed track your success in development. And that was
Yeah.
fantastic advice, Scott. And I would suggest go back, rewind that, listen to that again. And then what we're going to do is we're going to share your ebook article. I think we can share that, right? Well, maybe we can get a copy of that from you, Scott. And then I'm
Yeah.
talking to my producer, Lucas. We can share
Yeah.
that. Yeah. I love it. Okay, good. We'll share that. We'll have a download.
Mhm.
Maybe we could put that on our website. People can download
Sure.
it and then connect with
Yeah.
you. Another question for you, because we were talking about, kind of, you know, pitfalls. We didn't get into it, but you were saying, they can basically avoid mistakes by, just following along with a developer and kind of almost like interning with them. What's the biggest mistake that you've made as the developer, Scott? And how has that shaped you into how you approach deals today?
Yeah, actually, I mentioned earlier. So I described earlier when we created the UTH program, I did that experimental phase. That was on purpose.
Okay.
And the experimental phase, in a nutshell, was basically doing a series of very small projects, like smaller than I ever would have done in my life. I mean,
Hmm.
we were doing 2 and 3 and 4 and 7 unit UTH projects. And I've never done small projects like that in my entire career. But I had learned earlier, and this really showed up in the sort of 2005 to 2008 era. At that time, I was myself and a partner who ran the development operations for our company, and we basically took on some really big projects that we had no business doing. In other words, we weren't tuned up and knowledgeable enough to basically effectively manage those projects. Now we had the capital networks, we had the deal networks, knew how to underwrite it, but then as you go through and execute it, there were some key, things that we didn't know, and would be the way I put it. Like as an example, we had a terrible time managing the architects and the civil engineers and the structural engineers to all work together and work as a cohesive whole. And so because we didn't know to do that, we didn't do that. And because we didn't do that, when the GC went and built it, there was a lot of holes and gaps and flaws in the plans that is a perfect place for a general contractor to exploit, right? Change orders. Or the other issue is they're exploiting change orders and they have gaps in the plans that they've missed themselves, but yet the sub shows up and they want to get paid for that extra work. But what that did is that basically taught me that we should start small and grow our capacity to do these deals. Like when I did the first UTH deal, it was all of 2 units, Emilio, right? And I basically bought the land really well.
Hmm.
And I thought, well, gosh, if I screw this up, I'm still going to be okay. It won't be fatal to my company. It's not a big number numerically for loan guarantees or cost overruns, that kind of thing. And I'll learn some lessons. And I didn't even know necessarily what lessons I was going to learn. But in 2003 to 2005, we were doing some small projects at the time. And I remember feeling for me like, hey, I want to grow incrementally. I want to do it, I want to do a 20 unit project and then a 30 and then a 40 and then a 50. It was my fault ultimately, but I remember my partner at the time was a really relatively aggressive guy. And he
Hmm.
says, no, dude, don't screw around with that small stuff, dude. Let's not do that. And I, wasn't a strong enough, for myself to fight that off. And, I had ambitions too. So I was like, yeah, let's go do the 80 unit project. We
Hmm.
can get the capital. And in 2005, I mean, money was flowing like crazy.
Oh yeah, it was.
You could be a dumbass and get money,
That's
right?
right.
Like that was
There's still
time.
dumbasses that get money.
Yeah, I mean, look, it's a common repeated story.
Yeah.
And so when it came to UTH, I was like, man, let's just start really small, like really almost a joke small, right? Like I was almost embarrassed. I mean, still even today, I'm like a slightly cringe over talking about a 2 unit project. But man, we learned how to really execute well in
Yeah.
small projects. We got really good at building them out very cost effectively. We learned how to rent them. We learned how to finance them. We learned how to manage them, how to sell them. All the lessons you learn, and you do that repeated. I mean, this UTH program is the most consistently like sort of peer play, housing type that we've ever done, where we're just doing the same unit and same deal over and over and over, like production housing, like home builders. We also did that incremental growth of 2 units, then 3, then 4. So what you do is you learn those lessons. So just to finish up, when some people come to me and they say, hey, how should I get started? I'll give them the internship thing, I'll give them the JV thing. But some people say, well, I don't want to do that. And I go, okay, well then go build a single family house, right? Do the lowest, form of life in the development space that you could do. Maybe today you might say that would be go build an ADU, go buy a house and build one ADU, and then sell that and do that again. Then build 2 ADUs, then do maybe 2 houses and 4 ADUs or whatever, right?
Yeah.
But you're starting really small. It's really simple, and then you grow it. And there's be tons of lessons that you cannot learn when you go from here to here. There's just stuff you don't even know. You have gaps in knowledge, I call it, from that working learning group I was describing earlier. And so that incremental growth and lesson learning and knowledge building, even as sophisticated as developer. I mean, by the time we did UTH, I've been doing development for, 25 years. And I said, there's stuff that I don't know what I don't know. And so I got to learn that. I got to build the networks and the capacities to do that. And that was real key. And the last thing is that also gave proof of the model worked at lower risk, right? Because 5-bedroom apartments aren't exactly, when you show up to a lender or an equity investor, like, wow, 5 bedrooms, that's crazy, dude. That's extreme. That won't work, or that's impossible. And I go, hey, I've done 7 of them and they all made money.
Yeah.
Okay. So, I've got that proof. And so you basically track record, proof of the concept, all the lessons learning. There's multiple ways that incremental process helps you, grow and build, and then be ready for the big stuff, right? Then you're primed and knowledgeable to then make the leap to the next level.
That's fantastic. And if you're interested in learning how to become a developer, or how to become a bigger developer, you can grab a copy of Scott's ebook. We're going to go ahead and link it into our Instagram account. So if you follow us at Wealth Architect Podcast, you can go ahead in our bio. Make sure you follow us, by the way, in our bio. Go ahead and click the link tree, and it will take you to the article. So Scott, make sure you send that over to us. We'll put that.
The name of it is 6 Ways to Build Your Real Estate Development Career.
Beautiful.
That's the name of it.
That's fantastic, Scott. Hey, Scott, you know what? I have one other quick question to ask you before we let you go. You work with family offices. What are they really looking for in real estate right now that most developers don't understand?
So family office is one of our newer, so I work with family offices in 2 ways. One is capital, like you would think normally as a development shop. And in that instance, my experience, which is relatively new, like we've raised the least amount of capital from family offices, but they want like a steadiness to the sponsor, right? Like, often what we'll find with family offices, they'll go, okay, we need to test you out. We need to know you can execute well and be trustworthy. So we'll put up $100K on this deal. I mean, really small as a test case to make sure that the sponsor, us or whoever it is, works well, communicates well, executes well, right? And it's a way to, do like a test, but have it be low risk, right? So that's one. So they sort of start small and then grow. And then the other one is, in my experience, family offices are relatively slow to make decisions. And I don't mean dragging their feet unnecessarily, just not in a hurry, right? And you think about it, makes sense if you're, 4 generations of family wealth, like they did it that way. That's why they still have, generational wealth, 3 or 4 generations later, which is a rarity, right? So I think takes some getting used to. And then the other part where we work with family offices, which I'll just mention briefly, and we don't need to talk about it greatly today, but our company has a whole project services division. So we have a team of people that execute development on behalf of other parties that are not developers. So family offices are in that category. Same kind of family offices as my first example that I gave you in this answer. But in that case, basically we're helping families execute. So they've got land as an example, and they want to develop apartments on the land, but they're not themselves developers. So they'll pair up with our team, and basically we are the execution arm. We know how to do development, and we're doing development for somebody who's not a developer. And we, work with businesses, family offices, landowners, that kind of thing. So that's the other, exposure. That it's the same. It's the same general practices. Like cautious, slow to make decisions appropriately, right? Not unnecessarily. Want to make small, safe bets initially. Grow the relationship, and then often they want to do a bunch of stuff once they find that trustworthy operator, be it developer or service provider. Then often what we'll see is they go all in. They're like, okay, now we're going to do. You passed the first test, small bet, made money, great. Now let's go do 5 projects. In fact, the danger often is you go, hey, I don't want to do 5 yet. Let's do 2, and then 3, and then 4, and then 5. So that's once they make that decision and you can prove yourself as trustworthy, then usually, in my experience, that the spigot will turn on, maybe even greater than you'd like. That's a good problem to have.
That's a really good problem to have. That's awesome. The guest, Scott Choppin, and he is the CEO of Urban Pacific Group. And today we talked about urban townhouse models, which is a fantastic way to get a large rate of return on your investment. And again, Scott, you've been a fantastic guest. Thank you so much for sharing your knowledge. We're glad to have you in the Wealth Architect Network, and we'd love to have you back on. And again, for our listeners, make sure you follow us at Wealth Architect Podcast on Instagram, all other social media, but on Instagram, we've got a link for you in our bio where you can get a copy of Scott's book. Scott, give the name of the ebook again.
6 Ways to Build Your Real Estate Development Career.
Beautiful. Okay. Awesome. Good stuff, Scott. Thank you so much.
Thanks, Emilio.
Awesome. You're very welcome. Good stuff. Stay tuned. We'll be right back with Paul Benson, the #1 advisor at Engel & Volkers, with over 55 locations and over $3 billion in sales personally closed. We're going to talk about how to build an empire in real estate. We'll be right back here on the Wealth Architect Podcast. If you're listening to this podcast, you either own or will own a home, a car, and need life insurance. That's why you should check out our friends over at Lapointe Insurance, LapointeINS.com. These guys are the best in the business. They can help you if you're in Rhode Island or Massachusetts. And let me tell you something, his dedicated team of professionals are there to assist you and meet you where you're at. You never feel like you're being sold. You felt like you're being helped. It's a family tradition over at Lapointe. Check them out, Lapointe Insurance. Hey, a special thank you to our sponsor, AnnieMac Home Mortgage, whose Cash to Keys product is disrupting the industry. Sick and tired of finding the perfect home, not having your offer selected? I got to tell you, it happens all the time. With Cash to Keys, AnnieMac gives sellers a cash guarantee for each of their buyers' offers. Stop bidding and hoping. Instead, bid with AnnieMac and bid with confidence. Don't just bid, but win. AnnieMac Mortgage. All right, episode 11 of The Wealth Architect. We have on a great guest. I'm really excited to have this gentleman on, and I'm going to ask you a question to our audience, right? How do you go from selling homes to building a luxury real estate empire that spans 8 states, 55 shops, and billions in sales? Paul Benson didn't just ask the question, he answered it by doing it. And when it comes to building an empire, few have actually done it with this scale. Speed and sophistication, with the speed and sophistication of Paul Benson. As CEO and co-founder of Engel & Volkers Gestalt Group, Paul turned a single market foothold into one of the most dominant luxury real estate networks in North America, with over $3 billion in personal career sales, 3,000 plus closed transactions, and 800 plus advisors under his leadership. He's not just leading, he's redefining what's possible in the industry. In this segment, Paul shares the mindset, strategies, and systems behind his rise and how any entrepreneur with a vision and grit can build their own empire from the ground up. Paul, honored to have you on The Wealth Architect.
Thanks for having me. I'm excited to be here.
You're welcome. Thank you. So talking about an empire, I want to know this, right? I've always wanted to ask you, what was the first domino that you pushed to set this empire of 55 shops in motion? And would you do it the same way today?
Oh, good questions. The first domino was just that first phone call of I had made the decision I wanted to leave the brokerage I was in um, because I wanted a seat at the table. It really wasn't brand at that point. I was with the Blue brand, and the Blue brand was treating me quite well. I was top three globally for that Blue brand, but I didn't feel like I had a voice. I didn't feel like I had a seat at the table, and I had met a few people from the Engel and Volkers network. They were brand new in the West. There's only one location in all of the West, so it wasn't a company I knew very well. But I had met Anthony Hitt, who had been at the same brand I was coming from, and I like his personality, I like his style, I like his approach. But my why was to be able to just pioneer a company in Park City where I felt I would have a seat at the table because I owed my clients the service that I would be able to do the best job possible for their listings is really what it came down to. I had 141 listings the day I left Sotheby's for Engel and Volkers. And, to me that was a few hundred million in inventory. And I looked at that as my responsibility. So I had been at a company that was basically saying, you have so many listings, you're wearing down my marketing department, you're wearing down my people. And I'm thinking to myself, I'm a third of your business. Like it doesn't matter if I have one listing or 100 listings, these are the people that we serve. So we have to be able to serve them. So I just made up my mind. I wanted to build a company that was based on serving our listings and serving our clients. And so I wanted to say in doing it, what I didn't expect is that first domino it was actually Jean Merkelbach from Lake Tahoe. She heard about 2 or 3 days after I left Sotheby's what I was doing, and she picked up the phone and called and said, "I want to do this too. Let's do this together." I said, well, I haven't thought about doing this over state lines, but I'm sure we can figure this out. And that was domino number one. But your other question is, what would I not do again, or would I do it the same way again? No, I would not do it the same way again. You know what the original direction spurred from feeder markets, meaning here's our cross markets, whether it's LA, Newport Beach, Lake Tahoe. Here's areas where we see clients with wealth going back and forth regularly. So how can we work together better to service those clients as a team rather than, hey, I'm Park City, you're Lake Tahoe, you're Beverly Hills. How do we become one? And so that concept I absolutely love. I wouldn't change anything about it. But for me to truly service, because I started this thinking about servicing the client.
Mm-hmm.
And now I have to think about this as servicing my staff, my advisors, all of the people that are part of this with me. And I have to serve their clients. And I think it's harder to do when you're spread across 8 states than what I'd like it to be if I was able to drive to everybody and be a few hours away from you. I could just show up and look you in the eye any day I wanted. If I could do it over again, I'd probably desire that.
That's pretty, and I'm just in awe at what you're doing here, because I have a shop that is about 35 minutes from the other shop. I hardly get to go out there as much as I would love to, right? And it's like, you've got 8
Yep.
states, and I'm talking Western states, Rhode Island. You could fit hundreds of Rhode Islands in those areas. So I totally understand that. I feel that. Question that actually just came to my head as you were talking. In today's day and age with real estate, okay, you have your traditional type of brokerages like the Engel and Volkers, Sotheby's, really, really great brands, okay? And then you have all of these other brands like the internet type of brokerages, EXP, Real, okay? What do you think is the major difference as far as value proposition? And I'm curious, like, do you see what we're doing to be sustainable?
I do. It's interesting. I was recently at a conference in Dallas where kind of the heads of the different brokerages are talking about their value proposition and what it is and where they think it's going. The best quote I heard is AI today is the worst it's ever going to be. Every second from this moment is going to get exponentially better by the second. And our brains cannot, even at the highest of IQs, cannot comprehend what this will do for us within 10 years. And then I watched these real estate CEOs get up and talk about how they can create from the data and the amount of agents they have. Like if you have 100,000 agents and you have clients from 100,000 people, you believe as a CEO that now you have the data to almost replace the agent, right? And you kind of see as they're weaving their stories that this is what they're showing and selling their shareholders. They're telling their publicly traded boards that we ultimately will win at the real estate game because we're not relying on the agent anymore. And when you think about the masses of people, what I have found over the years is whenever I'm with a client and they say, well, why would I go with England Volkers or Sotheby's or Compass or the agency, more service focused brands? Instantly, you can get on a website and show them that, okay, this is the company that is supporting the agent that is my competition today. Is there anything on this website that is about you or about your home? And the answer is no, never. It's about recruiting agents, about growing company. So basically, they are hiring an agent who's in an island on their own to service this client rather than having a network behind them to do it. And that's what I think we double down on now, is because the more things become automated and the more systems there are, the more clients are going to gravitate to those who can be more community focused. What can you give me in a community? What experience can you give me to network me into the right places with the right people? What do I need to know that AI is not going to necessarily be able to feel the same way you would feel, Emilio? And I think that is absolutely a gift that we're going to have. I think what we do have to do, though, is stop saying we are the information. For decades, we've told ourselves they had to come to us, obviously before the MLS, and then came the MLS. Well, they still had to come to us because we knew the homes, and then they had to come to us because we knew which side of the railroad tracks the home was on, and whatever our story was. They do not need to come to us for information anymore. They need to come to us for service.
Correct. I love that. Putting the right people in the right places for them, having the overall network to accomplish any of their goals, personal, business. And really that's what it's all about. I love that. That's great. It's a relationship business. And I think all business boils down to that, especially real estate. When you're building an empire, right? How do you attract and retain top talent across 800 plus advisors while keeping a consistent culture and standard?
So we have about 12, I think it's 1,231 advisors as of this morning. And we keep track of, the fact that very few people do leave us, and but I also keep track of the fact that 52 of those are private office advisors. And that's the very pinnacle of England Volkers to be vetted, to have the numbers, but also have the personalities to actually want to put in the time with others and collaborate with others. They are the very best. And I would say the way that we've been able to attract them is every single thing in our organization is about them. Our staff, every single person wears the hat. It's almost like an upside down, pyramid where I'm at the very bottom of that pyramid, the absolute bottom of that pyramid. And everyone that understands that pyramid understands our clients are the top, and then just under the clients and almost right there with them is our advisor population. So our job is not to compete with them. Our job is not to make ourselves look amazing in front of them. Our roles and our job is to make sure that they look amazing and feel amazing, and are able to go out there and have the tools, the technology, whatever they're throwing at us, all the AI. It's my job to make sure we have a team that sorts through that and says, okay, these are the 3 things you should be paying attention to. And just make sure that every single week we are adjusting what those 3 things are, for example, so that our team feels supported. That's the bottom line. They have to feel cared for and supported.
I love that upside down pyramid. I'm taking notes over here as I build my real estate empire. And I want you to know, Paul, like the reason why we've designed the Wealth Architect is so that we could tap into, some wonderful guests like we could tap into your brain, and we can literally share what Paul Benson, one of the top real estate advisors in the entire world, is thinking, is doing to build his real estate empire. Paul, I love this. Let me ask you this. This is great. What was the biggest mistake? What do you think the biggest mistake is that you see agents or brokers make when they're trying to scale, and how do you avoid them?
Yeah, when you're out there trying to build your business, First thing you have to figure out is, who are you? What is it you do, and how do you live your life? What neighborhoods would you want to live in? And how would you want to receive communication in those neighborhoods? Because there's so many different ways to do this. When I have a round table of our 12 top people in any given market, almost every one of those people at that table will do it differently, but they're all really amazing at what they do. And I see people trying to get better, and they're thinking, well, so and so does postcards, I got to do postcards. So and so does door knocking, I got to do door knocking. Rather than just really figuring out, well, maybe you're an exceptional golfer and the people at the country clubs know you, but you just haven't been able to create that messaging around the skills that it took to put in the discipline and the time and the energy to become good at what you do, is now exactly what you do in real estate for them. And that you're going to be able to sell their golf home, not only because you play golf, but because you're able to communicate the discipline it takes to find the right home in the right neighborhood and so forth. You're going to be able to communicate that to your sellers. So I think really figuring out exactly what your messaging is and being true to you and getting that message out there in multiple forms and mediums, so that clients understand, that you're doing business. They get to know you as a household name, because most of the people you're marketing to, the odds of marketing to a person that's ready to buy or sell a home today is very slim to none. If you do the same thing for years, you're going to hit a large portion of that farm, whatever that farm is. And I don't think of a farm as a geographic farm. I think of a farm as a sphere of influence or a group or whatever that farm is. You have to decide today, I'm going to work this for the next few years. I'm going to create my business plan. I know who I am. I know who I'm going to attract. I know what my messaging is going to be. And I'm going to make sure every single person on that farm knows my successes, knows my level of service, gets to hear client testimonials, so that when they are ready, they will use me. And I still believe that if you kind of build it going into that one step at a time with a long-term timeline, and you are authentic to yourself, you're going to build an empire.
Absolutely. I love it. And really, like, deep down in your message too is all about the interpersonal relationships, the network. And it's funny, at the last private office event that we went to, I was sitting at a table. I think there was like 8 to 10 private office advisors at each table. And I asked them all individually, but collectively I said, what is your biggest, like, where are you getting most of your business? And they all said network, 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 network. And it's so powerful. It's so important. Great advice, Paul. I want to ask you this last question right now. I've got many more, but for time's sake, you've closed over 3 billion in sales. Okay. And maybe I was off, because I was off in your advisor count. I said 800, it was 1,200 and change, which is wild. But according to what I can see, you've closed over 3 billion in home sales. What habits or daily disciplines have remained consistent from day one for you to do that?
One of the things I'd say for sure is I'm instantly responsive. So if a client is trying to reach me, they're going to know that they can reach me 24/7. It doesn't matter if it's my wedding day. It doesn't matter if I'm on vacation. Nothing matters. They matter. I'm here to serve them, which takes me to the next thing is, often I find people trying to compare themselves to their clients, or even trying to level up or level above. That, oh yeah, they're buying their big home, but they're not going to treat me that way. They're not going to talk to me. Well, hey, it's not about you. They're going through something. They're going through a divorce. They might be going through a death in the family. This isn't about you. Your job is to serve them, not to take personal what they're saying, not to insert yourself in the deal, not to over negotiate a deal, any of those things. It's really to constantly remember we are here to serve. And then ultimately, I think it's you have to invest in your business as a business. And the most, highest return of investment I ever did was my first assistant. I bring this up often. Like, that is absolutely one of the very first big investments you can make in yourself, is to have to go to work and report to somebody. No, she's not reporter. He's not reporting to you. You're reporting to that assistant, because now you have to explain to that person what it is that you need to help you as a team make more money. So now you have to go into work that day with a game plan. You have to hold yourself accountable to show up and say, hey, this is our business plan, and this is what we're going to do, and these are the areas I need you to focus to get us there. And as you start growing that and you start thinking that way and you start really kind of applying the process, that snowball just keeps getting bigger and that team keeps getting bigger and your name out there keeps getting bigger. Because when you were at that table and you asked every one of those people, where are you getting your business? They all said sphere of influence. But what I find is that there are definitely people that get in this business that have a huge network, but can't ever capitalize on it. The difference between those amazing stars that are capitalizing on this is that they have done all of the other things that you just don't see. They have the resume, they have the client testimonials, they have the team to support the client so that when that big client knows, hey, you're sitting in a steam room in this country club with me talking about deals, but I happen to know you have a team that's going to be able to respond to me no matter what home you're showing in that real time. I think it all starts tying together in the big picture. So every one of those little details starts mattering. You don't shortcut them.
Yeah, I love that. Great advice, Paul. I could talk with you for another 4 hours, but I know you don't have the time. And our podcast, unfortunately, doesn't have the time. But listen, the number one advisor across the network of Engel and Volkers, and probably the top across the world. Also a Realm Global advisor, and you're a member of Realm Global, which is awesome, and a private office advisor, as well as licensed partner of over 55 shops with the Gestalt Group. It's none other than Paul Benson. Paul, thank you so much for being a guest here with us in The Wealth Architect.
Thanks for the invite. Thanks for your time. It's always great to see you. Will I see you in Portugal?
Always great to see you too. Yes, I will be in Portugal. That's in October, private office event. Yep, I'll be there. Do you own a European or a Japanese car? Are you looking for a reliable, trustworthy, experienced place to take your car to get repaired? Look no further than our friends over at Elite Auto. They're not only going to welcome you with a smile into their ultra clean facility, they're also going to give you a rental and make sure that you are taken care of while your car is being repaired. They've got master technicians that know how to diagnose and fix any problem your car has. Elite Auto, building relationships for the road ahead. I got to tell you, I had a blast today. We had some amazing guests here. And, if you're not subscribed to us on YouTube, you need to check it out. We are the Wealth Architect Podcast with Emilio DiSpirito. And make sure you follow us on Instagram so you can stay engaged with all of the latest content and you can grow and build your wealth. Let's do it together. We'll be back here next week on SoundCloud, Spotify, iHeartRadio, YouTube, and Instagram. All of the major platforms. We're there. We'll see you then.